Assalamualaikum to Dr. Sabaria. We are from Group Striker and we will explain this case study form. Next, I will pass to the first presenter.
I will continue to present for question A1. Business risk refer to uncertainty or threatens an organization's ability to generate profit. So the factor affecting business risk can be defined as the variability in demand. The operating income fluctuates widely if the variability in demand for the firm's product is larger, so it is more exposed to business risk. Then, variability in selling price is when a firm's product does not sell at a constant price. It may be related to the factor of changing demand and supply condition, nature of competition, and so on. Thus, larger variability in selling price will lead to higher business risk. Next, uncertainty of input cost. The total operating cost of the firm widely fluctuate if the uncertainty associated to input cost is larger. This exposes to the firm to high business risk. Question A2. Operating leverage is the lever to which fixed operating costs are utilized in an organization process. It also refers to the use of fixed costs rather than variable costs. So, how operating leverage affects business risk is when most costs are fixed and thus do not fall when demand falls. The firm has high operating leverage. Question B1. The meaning of financial leverage is the degree to which the organization use fixed income securities such as preferred equity and debt. The greater the firm reliant on debt financing, the greater its financial leverage. For financial risk, refer to additional risk over and above the corporation inherent business trade. The risk is accepted by stakeholders as a consequence of the firm's decision to fund with debt. Question B2. Financial risk related to how a company uses its financial leverage and manage its debt, while business risk related to whether a company can make enough in sales and revenue to cover its expense and turn a profit. So the difference that we can see is the financial risk. There is a concern that a company may default on the debt payment, while business risk, the concern is that the company will be unable to function as a profitable enterprise. Question C1. So this is the complete income statement for the firm L. In this slide, I have shown the calculation and formula for each item. So the answer for interest is 1200, earning before tax is 1800, and tax amount is 720. Continue, the income is 1080, return on equity is 10.8%, and lastly, time interest earned is 2.5 times. Question C2. For this question, it shows that company L has a higher ROE than company U. It indicates that the use of financial leverage has increased the expected profitability to stockholders. So the higher expected ROE is due to the tax saving. Then company L has a broader series of ROE and a higher standard deviation of ROE. It also indicates that its higher expected rate of return is accompanied by higher risk.
I will continue for question D1, 2, and 3. Optimal capital structure can be determined by how its equity and debt are allocated. At the optimal capital structure, the wealth of the company is maximized, while the cost of capital is minimized. This is the sequence of events that will occur if CDSS divided its capital structure to include more debt. There are 4 steps and I will explain shortly. Step 1. CDSS should declare their recapitalization policies to stabilize the capital structure back. Step 2. The stock in the corporation will have some market value prior to be filling in this case. The corporation will have to estimate the value that they will have to pay for the shares that was repurchased. Step 3. CDSS might need to repurchase the share at its current value. Depositors will re-evaluate their opinion given to the new capital structure regarding the company's profitability and risk. The share price might increase and reach a new equilibrium after the recapitalization. And the last step is CDSS will buy the share, issue the debt, and use the proceeds to pay for the share it has previously purchased. After the recapitalization, there is more debt outstanding but less common stock. The value will be set at its new level when a new EPS has been computed. And this is the expected earning per share EPS and times interest earned for 5 debt levels given. At 0 debt level, the EPS will be $3 and the time interest earned ratio is infinity because the EBIT is divided by 0. At the debt level $250,000, the EPS will be 3.25 and the time interest earn ratio is 20. At the debt level $500,000, the EPS will be 3.56 and the time interest earn ratio is 9.1. At the debt level $750,000, the EPS will be 3.86 and the time interest earn ratio is 5.1. And the last one, at the debt level $1 million, the EPS will be 4.08 and the time interest earn ratio is 3.1. I think that's all for me. I will pass to the next presenter. Thank you.
For the question 4, calculate the new stock price of CDSS. New stock price is calculated by dividing the dividend by the difference value of required rate minus growth. So the new stock price when debt is 0 is $20, when debt is $250,000 is $21.03, when debt is $500,000 is $21.58, when debt is $750,000 is $21.44, and lastly is when debt is $1 million is $20.40. Next question is, what is the optimal capital structure of CDSS? What can be seen through the calculation above is that the debt level of 500,000 results in the highest new share price of 21.58 when compared to other values. As a result, it can be concluded that CDSS optimal capital structure should be at this level. For the next questions, is EPS maximized at the debt level that maximize share price? Earnings per share do not maximize the share price. The debt level that maximizes a company's earning per share is usually higher than the debt level that maximizes the company's share price. Maximizing EPS usually requires a higher level of debt, which involves a higher level of risk. A higher risk level has a negative impact on the share price.
I will explain about question D7. The question is, what is weighted average cost of capital at the optimal capital structure? We will use WACC formula, which we can see in the slide. Total assets was given about $2 million, cost is 11%, tax is 40%, debt is $500 million, equity is $1.5 million, and required rate is 16.5%. We put all this value in the formula and calculate so that we will get the answer, which is 14.03%. Hence, the weighted average cost of capital is 14.03%. Next, question E, which asks what if the firm had less business risk than originally estimated. The answer is, at any debt level, CDSS would be more likely to suffer financially if it had a higher business risk. Depositors would become aware of this, resulting in higher than expected cost of loan and required rates of return. This analysis does not indicate it, but the optimal capital structure with the least amount of debt would be the outcome. On the other hand, a capital structure with a higher proportion of debt would be optimal if there was less business risk. Next, question F, which asks what are some factors that should be considered when establishing a firm's target capital structure. The answer are reserve borrowing capital, the average debt ratio for organizations in their respective industry, total asset structure, tax rate expected, and lastly, rating agency attitude. Last question is question G, which asks how does the existence of asymmetric information at signaling affect the firm's capital structure? The answer is the concept of unbalanced information is founded on the assumption that the method of financing an organization sends signals to depositors. Companies with good investment prospects want to split the profits with new shareholders, so they'll be more likely to borrow money to finance their operations. On the other hand, organizations with weak prospects will require share funding. Depositors are aware of this, therefore when a large established company announces a share offering, stakeholders interpret it as negative news and the value of the stock falls.